Hi, friends. So, welcome to this particular session. We want to look at evolution of financial reporting, more or less. You would have seen in the previous presentations, financial statements, ratio analysis, which were typically dealing with numbers. But is it all about numbers, or there is something more we can do to it? I can tell you for a fact that today, if you pick any annual report, the the quantum or the proportion of non-financials, the narratives, far exceeds the financials. No two ways about that. Because with accountants, we are not only presenting numbers, we're communicating the reality behind the numbers. So we need the narratives, we need the non-financials, we need the explanations, the notes to the account, so that somebody who doesn't really understand the numbers can make meanings from reading these notes or these narratives. I share my screen and then we kick off. So we're looking at integrated reporting, a core component of any assessment which comes under modules like this. Okay, so let's kickstart and see how far we can cover some concepts. So like I said, we're going to look at the evolution of corporate reporting. So integrated reporting, we'll look at that. We'll focus more on integrated reporting. Okay, let's see what we have. So at the end of this, you should be able to describe how corporate reporting has evolved over time. There are timelines. There are timelines as well. You don't need to grasp them into your memory, but if you can, that's great. We also want to appreciate the features, the purposes of sustainability reporting and integrated reporting. And then we'll analyze some recent examples of integrated reporting practices. Okay. All right. So we're going to look at financial reports, how they've migrated into integrated reports. Okay. So we're looking at financial statements, management commentary, governance reports, ESG impacts, and then corporate communications. And these all feed into this whole big concept we call sustainability reporting, honestly. So sustainability has two legs. Keep note, it has the financial sustainability and then the environmental sustainability. So simply put, sustainability, we are saying to what extent can we, the current generation, enjoy what we have without compromising on the needs of the future generation enjoying theirs. So don't enjoy all alone today and destroy the system for posterity not to enjoy. Okay. So use what you have, but make sure you don't destroy what the future generation will need to enjoy. So that's it, purely for sustainability. So it will cover both the financial and then the environmental, the bigger picture, the ecosystem. Okay. Let's start with a few examples. So Novartis. Novartis has its annual report. You look through this particular link and you will get a detailed information. They're covering both financial and then the non-financial. AXA similarly has its annual and interim reports. There's an archive. You go in, you get it. Coca-Cola will also give you this in this report. What we should know is that these are just this list not exhaustive. What we should know is that some companies will prepare their sustainability reports as standalone reports. Some will integrate it into the annual report. So you could get a bigger one comprehensively presented, or you could get a standalone integrated report. It's standalone sustainability report. Okay. All right. So integrated, it covers everything, but the standalone will be standing alone, like the name sounds. Traditional financial reporting, a major function of corporate reporting is that we want all stakeholders, not shareholders, all stakeholders, the information they need so that they can conduct their business and also do what? Make informed decisions. So the key things here we want are accountability. So the numbers play a key role there. Transparency. So the narratives help us to better understand this dimension. And then future business ventures, which covers both the financial and the non-financial. Now, confidence in investors and other stakeholders, we want to build that. So let them take their annual reports and they should have confidence that we are doing well as a company. Again, this report should be able to allow us to get access to finance and lower cost of capital when we go to the lenders. Again, these reports are intended traditional financial reports typically helping us to build better relationships with our suppliers, with our customers, and then greater trust from our employees who work for us, including the management. But again, there's a transformation function. What is it? And that is where we're saying that the stakeholders are able to receive and evaluate the information to try to actively bring change where they see opportunities to influence corporate behavior. So regardless of all of the things we've mentioned, the stakeholders want to be able to get value from the report. Okay, value from the report. Sometime back in the year 1769, I believe, 1976, not 1769, 1976, I think they even came out with this value-added report, like the name sounds, but it is purely a tweaking of the income statement to show that the income statement adds value. But I believe that all the reports, all the financial statements add value. The balance sheet adds value. The cash flow adds value. The notes to the account adds value. The statement of changes in equity also adds value, not just the income statement. So the value-added statement has always had some questions. Anyway, let's move on. So beyond the financial statements, corporate reporting has undergone various transformations. So the landscape has changed because stakeholder needs keep changing. So we have to go beyond the traditional numbers, the balance sheet or the statement of financial position, the income statement, the cash flow statement or statement of cash flows. And we want to go beyond it. So we want to look at management commentaries. Like the name sounds, management will provide us some commentaries, which adds extra layer of value to the accounts or to the reports. Governance disclosures, footnotes to the account, external auditors giving us their reports, their management letters, their annual report of findings, name it. So that stakeholders, we can have better understanding of this value creation process. So corporate reporting, users of corporate reporting still find the financials good, but without the narratives, they find it to be incomplete. So what we are doing here is that let us include some non-financial information to reduce the material non-financial risks, okay, to create value and to ensure that the stakeholders are fully satisfied. EY, Ernst & Young gave this profound statement about value. They said in 2014, they said, the economy is facing a new value paradigm. These changes, however, are not reflected in the way we measure or report value. Traditional corporate reporting models have failed to adapt to an uncertain economy and account for the increase in tangible assets. So traditional metrics for measuring value and economic progress no longer provides a complete picture. So let us change the traditional. Today, we want it to be more of multidisciplinary. Okay, as an accountant, if you ask me to go and measure the value in the natural habitat, difficult. I don't have that skill, but I need the environmental specialists, okay, the sustainability reporting specialists, the scientists, the engineers. So they come and we can break that silo of traditional reporting, get in some non-traditional measures so that value will be expanded. The concept of value will be expanded. There are limits to traditional financial reporting. Over the past 40 years, organizations have been disclosing an increasing amount of information to satisfy stakeholders. Today, stakeholder needs are changing, so give them more. We keep giving them more. We keep them giving more. But unfortunately, the information is disjointed. Financial reporting has become complex and it requires technical knowledge. Look at the various accounting reporting standards surrounding these numbers. The current economic, social, environmental crisis are also forcing us to think differently. So let's bring in more of an interdisciplinary approach, okay, instead of just the traditional financial approach we use. Again, there's a lack of regulatory framework for non-financial reports. So even management accounting typically doesn't have even a standard which regulates them. I mean, when I say standard, I mean like the IFRS or the International Accounting Standards. Okay. So if you are providing a management commentary, if you are providing a report on anything non-financial, do we have a regulatory framework? The reality is that things have changed. Today we have the SASB, we have the IFRS S1, S2, which is providing some reporting framework so that we can measure consistency. We'll get there. We are not there yet, but I'm sure we'll get there. We'll harmonize some of these principles, these reporting standards. And at the end of the day, we'll come up to something similar to this IAS or GAPS or the IFRS. But we are there. The IFRS Foundation now has IFRS S1 and S2, which is purely dealing with sustainability and climate reporting. Financial reports fail to reflect the ability to create value. So, because it's typically historical, but we want something which will create value in future. Okay. And then the roles of intangibles are also changing. We need them. We need to value this. We need to incorporate this towards our overall sustainability reporting and integrated reporting. Okay, look at how it has changed over time. Somewhere in the 1960s, we had a financial statement taking the airwaves and dominating all reporting platforms. Towards the 1980s, the financial statement incorporated the management commentary, also with governance and remuneration reports and environmental reporting. In the 2000s, you realize that we now added some elements of sustainability reporting. From 2020 to this time, the financial statements appear to be a bit smaller. You get more financial information, sustainability information, management commentary, governance and remuneration feeding into the integrated report. So you get the 6 multiple capitals and integrated reporting. Talk of the social relations, talk of the human capital, the intellectual capital, the financial. Okay, you look into this, you realize that integrated reporting has evolved over time. Let's look at why integrated reporting. It's more than the financials. Okay, the market value, Standard & Poor's 500, gave some statistics up until 2010, not too current, but let's see what happens. Now, in the 1975s, the intangible assets were just about 17% compared to the tangible assets of 83%. And look at how the intangibles have increased. In the 85, became 32%, 95, 68%, and 2005 and 2010 are now like 80%. And the tangibles are just 20%. It tells you that there is the need to change our reporting altogether. Reporting content have changed. The strategic issues have broadened up to become strategy and governance. The forecast plans have broadened out to become the implementation plans. And the past performance, business as usual, is something we don't downplay it, but typically it is more historical. So we want to keep it as business as usual and a bit smaller. So where would your focus be? Focus should be on strategy, governance, implementation plans, detailed implementation plans, which look into the future. So we want to create value, business value. Therefore, look more at future items which will give us value. Let's look at this quote, okay? And what will be your views on this? The End of Accounting and the Path Forward for Investors and Managers by Baruch, Lev, and Feng Gu. Now, this publication, an extract of it says, we don't recommend getting rid of financial reports. No, never. Financial reports as an historical document will always be important because we need the past. And if we don't understand the past, how can we plan for the future so that we don't commit the errors of the past? So the past is always necessary. It's a platform, it's a foundation for us to build onto the future. You need to have some kind of historical perspective to the business. Lev, a professor of accounting and finance at New York University Stern School of Business, acknowledged in an interview with CFO. This is what he said, right? Now, there is some importance in knowing the past, he added. I don't completely disregard it, but it doesn't give you linear information about what will happen in the future. It gives you more of a distorted, like a contour line. not a linear information about the future. I agree. And what are your views about this? You can brainstorm and think about this, like I have said. Sustainability reporting is a report we publish, the organizations publish. It covers economic, social, and environmental. In fact, sustainability reporting is more like an intersection. Have you seen the diagram here? So the economic stance on its own, give and take. Environment stands on its own. Social and governance stands on its own. And sustainability reporting is an intersection of these three. It cuts across everything. It cuts across everything. So we have the GRI standards, which is very good. I mean, it is not typically a mandatory guideline. It is it's an initiative. So you got a GRI initiative. They publish the GRI standards, sustainability standard. Companies are actually asked to adopt them, but trust me, they choose and pick which ones helps them. Not typically mandatory. It helps governments, it helps businesses, other organizations to understand and better communicate their sustainability impact on the society. And it covers all the three dimensions of sustainability. The importance is that reporting is not a PR exercise, it's a value-adding exercise. It helps to interact with shareholders, stakeholders alike, everyone. It is quite transparent because it gives you a broader picture of what goes into the numbers and the non-financials. And anyone who does this, we are also made to understand that it enhances their brand image. People who, organizations who typically engage in sustainability reporting are seen to be transparent, and people tend to, or customers tend to patronize them a lot. We move on. Let me go one step back. There used to be the GRI database, I think somewhere in April 2023, thereabout. Yes, it's they were not getting value for the sustainability reports people are uploading, so the database shut down. I personally had used the database for my PhD research, very good database, but apparently the people, the handlers were not getting value, or they are incurring more cost than the benefits they are getting. So the database shut down. Very good database. The big five or the big four items we would want to hit. Okay, so the GRI, Global Reporting Initiative, they help us with the GRI standards, like I mentioned earlier. We have the integrated, in fact, we used to have the Integrated Reporting Council, International Integrated Reporting Council, IIRC. And then they joined forces with the Sustainability Accounting Standards Board. These two used to be standalone regulatory bodies, but they came together they formed one group, and they changed the name to the VRF, Value Reporting Foundation, right? So that's it, 10 years of integrated reporting. Looking at the climate, then we also have the Climate Disclosure Standards Board, and we have the CDP. So these are forces which have joined efforts in order to make sustainability integrated reporting meaningful. Today, the VRF has also joined with the IFRS Foundation, and they've come up with this IFRS S1, S2, right? And things will keep changing. Who doesn't know the 17 Sustainability Development Goals? You don't have to imbibe all into your head, but at least you should know 5 to 6, okay? So it will change. I will not be surprised this will increase. Today we have 17 UN Sustainable Development Goals. It may increase. All right, so currently we have no poverty, zero hunger, good health and well-being, quality education, gender equality, clean water and sanitation, affordable and clean energy, decent work and economic growth, industry, innovation and infrastructure, reduced inequalities, sustainable cities and communities, responsible consumption and production, climate action, life below water, life on land, justice, peace and strong institutions, and partnerships for the goals. All right. The SASB materiality map, you don't want to We get these things typically on hand. We get a natural accounting protocol toolkit. We can always use this whenever we need it for a hands-on approach on our work. But let's just touch on the key items of the materiality map. So it's looking at environment, leadership and governance, business model and innovation, human capital, and social capital. Okay, so that's the universe of the sustainability issues. And these are examples we've cited. Under environment, you can always talk of the greenhouse gas emissions, air quality, energy management, water and sanitation, name them. Under leadership, we're talking of business ethics, competitive behavior, critical incident risk management, systemic risk management, right? Talk of business model and innovation, we're talking of product life cycle, the business model resilience, supply chain management, material sourcing. Come to human capital, talking of effective or efficient labor practices, health and safety regulations, and diversification. I'm not saying diversification, diversity and inclusion, no discrimination. And then we come to the social capital, talk of the human rights, customer privacy, data security, quality, product quality and safety, customer welfare, so on and so forth. The non-financial reporting, EU directive under EU Directive 2014/95 EU requires large companies to disclose some amount of information on the way they operate and how they manage the society and environment. Who does that? Typically, we consider large public interest companies with more than 500 employees, approximately 6,000 large companies and groups across EU can be found in this segment. And what do they report? Their environmental, their social, respect for human rights, anti-corruption and bribery, diversity on company boards, so on and so forth. If you go to South Africa, we have the Black Empowerment Metric, where on the board there should be at least one Black person sitting on the board on the highest level. And it enhances their image. It got some risk sides, it got some good benefits, which helps the economy at large. Okay. Companies may use international, European, or national guidelines, the UN Global Compact, the OECD, Organization for Economic Cooperation and Development guidelines for multinational enterprises could be used. They could use the GRI standards. They could use the ISO 26000, name them. So that's it. So you realize there's no consistency there in terms of what they need to use to report. Choose and pick, okay? Sustainability in practice. Have we seen this before? Yeah, over and over. Environment and sustainability, there's this publication, University of Roehampton recognizes its duty to protect the environment and to also conserve the biodiversity of our green campus. Sustainability. Today in the UK higher education sector, universities are even ranked as the best university in sustainability. I think in 2025, it was the Reading University. Yeah, 2025 was the Reading University. Another publication you could see that it says, see Kate Middleton's glamorous and sustainable rewear on the BAFTA's red carpet, promoting it, right? ABN AMRO Group, they have the Impact Report 2018. It included integrated profit and loss and other impact statements. So we see these in practice, okay? Integrated reporting, the IIRC defines it as a process founded on integrated thinking that results in a periodic integrated report by an organization about what? Value creation over time and related communications regarding these particular aspects of the value creation. So integrated reporting is not merely talking about just reporting in groups. No, it is typically looking at value and the reasoning behind the value. Right. Now, the concept of integrated reporting was introduced in South Africa as far back as in 2009 through the Kin 3 account. So this is the code of governance. Sometimes you see Kin 2, Kin 3. Okay. Now, what happened here? The Joburg, today we call it the Johannesburg Stock Exchange Limited. So the Johannesburg Stock Exchange adopted the Kin 3. And all listed companies on the Johannesburg Stock Exchange Limited are now required to apply or explain the Kin 3 principle, of which IR is one. So have you seen what is happening here? Principles-based, not rules-based. Principles-based, not rules-based. Okay. So we would always want you to try something and then explain if you know you cannot meet it. And this is what is happening. Now, the International Integrated Reporting Council, set up at the end of 2010, also aims to create the globally accepted IR framework. It's got pillars. It's got pillars. So that's what we want you to know. It's got about 6 or 7 pillars. The integrated reporting framework got about 6 or 7 pillars. Now, we want to also look at the typical item here. So in the world of integrated reporting, we have the 6 multiple capitals. We have the 6 multiple capitals, which I would always want you to look at. So integrated reporting, look at the mind map, the value creation map there. Beautiful, right? Okay, in 2013, they published this, and they said an integrated report is a concise communication about value creation, both in the short, medium, and long term. And it is also communicating the aspects of this. What are the aspects of this? And this comes back to these 6 multiple capitals. Okay, we've got the financial capital, you know them, the numbers, the cash. The manufactured capital, the product, right? The intellectual capital, the brand, the patents. The human capital, the human resources you can think of. The social and relationship capital, I come to the workplace and I'm not happy. Why should I come and work? I only come to make money. So the social relationship, and then the natural capital, the environment. So all of these go through some kind of, should I say, processes or integration to achieve the mission, the vision of the organization. There are risks and opportunities. We'll find them, we'll solve them, we'll capitalize on the opportunities. We use our resources, our strategy, and put them together, get our inputs, process them with the business activities, get outputs, and outcomes are then reported in the same manner. In the same manner. Okay, that's the value creation process. Any question on integrated reporting should at least touch on these 6 multiple capitals. All right. There are benefits of integrated reporting. The benefit is that it provides greater clarity about the relationship between financial and non-financial and how it affects value creation. It is also a way to better understand internal decision making for strategy. Sustainable strategy, of course. It also provides a deeper engagement and improved relationship with all stakeholders, not just shareholders. Lower reputational risk. Do it and you get a better reputation. It also improves measurement and control systems for non-financial information. We can always get good metrics for measuring financial information, but this also helps you to measure non-financial information. Greater employee engagement because we need everyone on board to help us. You see human capital there. We need them on board. It also provides more committed customers who care about sustainability. You co-opt or you get to retain your customers and even attract new customers. The cost. Preparation cost can be very high. How to collect non-financial data, to analyze them, especially when there's no clear-cut tools to analyze them, can be difficult, can be costly. Infrastructure investment in new information system and data set can also be a daunting task. Then this requires new processes, new control systems. How would you adapt it? Will people easily accept it? Would you also get people with such analytical skills? Will you get assurance from third parties? What about potential proprietary disclosure cost and revelation of competitive information? If you're not careful, you end up disclosing your competitive advantage to a rival company, and he will pick up on it to outcompete you in the market. So it comes with benefits, it comes with cost. So these are examples we've cited here for integrated reporting. If you go to their website, you said Abedrola has one, ABN AMRO has one, and then this particular company, Assicurazioni Generali, also has an example of an integrated report. All right, so we're wrapping up. Again, many publications on this have gone on in the years. We've got this by Cristiano et al. Determinants of companies' level of integration. Does one size fit all? Definitely, when you read it, you realize no. So there's another one there by the British Accounting Review, which has been published there. Integrated thinking, the CIMA Global Academic Research. So all professional bodies are all thinking alike. Integrated reporting, the role of corporate culture and the choice of integrated reporting, right? And I end here. All right. So yes, so friends, as much as you can, it is always good to take a look at some of these reports and you better understand how it is written. It is selling a lot in the corporate world of reporting. It is selling a lot. Don't just get stuck to the numbers. Move beyond the numbers. If I put down numbers and I can't interpret, I can't explain it, there's no need. All right. It doesn't really provide value. Value is not only limited to numbers and figures. Value goes beyond the numbers. Right. I'll see you on the other side. Bye for now.